Fundamentally, there's a whole number of different things that drive a rental shortage, rental surplus, housing demand, lack of housing demand, and it can be a handful of different things. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. And this week's episode, I want to share 3 data points that I recently came across that I think really capture what's going on in the multifamily real estate market right now and what they mean for investing in multifamily and what's going to go on the multifamily sector moving forward, at least in my opinion and my own interpretation of this data. So this week's episode is going to be a little bit more of a current events conversation, and I think it's going to be very informative for the multifamily investors out there who want some more data-driven insight into what's happening in the market. And this is going to be a nationwide conversation. We're going to chat about some specific markets throughout this particular episode, but broadly speaking, whether you're in New England or the West Coast or the Southeast or the Southwest, you're going to get something out of this episode, in my opinion. But before I get into those 3 data points and the 3 trends that I'm keeping an eye on right now, I want to remind everybody that Sterling Realty Apartments, our 72 units Class B light value add multifamily investment opportunity, is still live. We're working towards the completion of that raise over the next couple of weeks. If this is a deal that you want to learn more about, click the link in the show notes to be taken to the deal room where we have the PPM, the OM, a recording of the webinar as well. This is a 72 unit deal, direct to seller, sourced from a mailer, bought from a very long-term owner. And we're going to be able to create a significant amount of value through just managerial improvements, which are my favorite deals in the multifamily game, are the ones where we can come in and create value through just improving the operations, improving the quality of management, and optimizing the rent roll versus spending a bunch of money on CapEx and doing a more moderate heavy value add from a construction standpoint. So if you're looking for a cash flow heavy deal that we're really excited about, we're going to be sizably co-investing in this deal. Click the link in the show notes to go learn more about it. But let's get to this week's solo episode. Okay, so 3 data points that I think capture what's going on in the multifamily sector very accurately right now. And I think that these are going to be enlightening data points for those of you investing in multifamily. First one that I want to talk about is just year-over-year rent growth. This is data that we're pulling from RealPage, or I should say that RealPage publishes. Jay Parsons takes it out to LinkedIn. One of the best connects that you could have on LinkedIn. He's a fantastic follow as it relates to putting out extremely informative data as it relates to rental housing, not just multifamily, but the single family rental sector as well. This data is just broadly speaking across the board, but it's interesting because I think there's some key takeaways here. So September data is out, and it's basically nationwide rent growth from September to September of 23 to September of 24 is about 0%, 0.18% to be precise. And a lot of that is driven by new supply, which I talk about a lot on this podcast feed. Anybody who I've chatted with about, for example, the deal that we're raising for right now, spending a lot of time talking about supply and really the lack thereof in many markets throughout the country. However, this is interesting data because there's a lot of markets that are right now temporarily being oversupplied as it relates to the temporary demand. A lot of the southeastern markets, southwestern markets, you have markets like Austin, where rents have fallen over 8%. Over the last 12 months, Huntsville, Alabama, -5, Fort Myers, -10, Sarasota, -5, Denver, a little over -1. So there's a lot of markets where rents are falling, but there's also a lot of areas within the country where rents are rising. Northeast, parts of the West Coast, really areas that are supply constrained, where even if you don't have that massive population growth, there's some growth, and let's just say that supply is not being built fast enough to exceed that growth or the temporary demand for housing over this last 12-month period of time. Now, what is interesting here, and this is one of the data points that I think is interesting, according to RealPage, we're a couple months away from erasing the entire rent over wage hump from 21 and 22, which, put in another way, there was this massive disparity between where the size of, or the rate of rent growth from 21 into 22, where rents were growing double digits in many markets throughout the country, but wages were not increasing at the same rate. Now that gap is closing, or has become much, much smaller. And most of the markets throughout the country where rents are flatlining, they're maybe growing 1-2%, or they're falling, but wages are continuing to grow, and that's a much healthier balance. And I think that's a really key data point here. Now, something that plays into this is in the second data point that I want to share, and we just talked about supply. I think this was a very interesting stat. We're going to add more new apartments in the first 9 months of 2024 than we did in any full year since 1987. So I'm going to repeat that. In the first 9 months of 2024, more apartments are being built than any year since 1987, which is a massive stat. Now, that's driven by a lot of things, right? 21, 22, when a lot of these projects were started, we have ultra low interest rates, we had ultra high demand, we had double digit rent growth, we had cap rate compression. It was an environment where there was a lot of folks who were very eager to build housing. And a lot of that supply is coming online right now, which obviously drives a lot of the rent flatlining from a growth standpoint that we just talked about on point one. Now, what's the takeaway here, right? And I think that there's a lot of folks nationwide who have this thesis, a lot of institutional investors for sure, the large equity residentials, the Blackstone, like a lot of the massive apartment owners. A lot of their thesis statement around investing right now is rooted in that there's going to be this fall off in supply in terms of deliveries coming in 25 and 26. And conceptually, that makes sense. Not a lot of incentives to start projects over the last couple of years because rates were really high, construction costs were really high, and there was all this supply coming online. So there was less enthusiasm around building more apartments, but we're already building a ton of apartments, and we're starting these projects in an environment that really increased costs through the cost of capital, interest rates, as well as the cost of construction. And also rents were coming down as well. So now we're underwriting lower rents when we complete, which makes it harder to underwrite projects. So a lot of folks are doing deals right now with the thought process that rents are going to spike in 25 and 26 because we're not going to have as much supply coming online as we do this year. And that conceptually, again, makes sense. But it is really interesting to note that we have all of these apartments coming online this year. And rent growth in many markets throughout the country kind of, it's around 0%. That's the national average, 0.18 to be exact, but basically 0%. So despite the environment in which we are building all of this housing, in a lot of markets, rents have just stayed, consistent, right? 0% growth on average. And there's a lot of states where maybe we're growing a few percent, a lot of states where we're falling. And then you have the outlier markets where rents are still growing quite a bit because of severe supply constraints. And then you have some markets where there's all of this supply being added, like Austin, which I just mentioned, where rents have just taken a bit of a hit, a significant hit, dropping 8% year over year. No matter what happens here, it's likely, in my opinion, that a lot of these markets that have been temporarily oversupplied, supply just exceeding demand for a period of time, probably going to rebound from a rent growth standpoint. And the supply constrained markets, and I'm going to just use New Hampshire as an example here. There have been a lot of new projects introduced in New Hampshire over the last 12 months, still a shortage of what the state needs from a housing standpoint, but there have been more apartment communities built in the last 2 years than any time that I've at least been in the real estate business, really from 2016 up to 22. And rents have still continued to grow in New Hampshire, broadly speaking, right? If you look at the New Hampshire Housing and Finance Authority's rental survey on an annual basis over the last few years, it shows rent growth, rents increasing in the vast majority of the markets throughout the country. I should say submarkets. So when supply falls off, as it will in 25 and 26, compared to what's been delivered over the last few years, that problem only becomes exacerbated. And I think that's a really important data point. That brings me to the third data point that I'd like to talk about, which is while apartment rents are flat or falling in most parts of the country, there is still considerable demand for housing. And I think that there's a lot of people that think about demand for housing, supply for housing, and I get this question a lot, like, how can there be a housing shortage? Where are all of these people living? And it's conceptually an interesting question, right? Fundamentally, there's a whole number of different things that drive a rental shortage, rental surplus, housing demand, lack of housing demand, and it can be a handful of different things. So, for example, you have all demand for housing increases when households decouple, right? Let's say you have 3 roommates living together. They all start doing well in their jobs. Wages increase. They can afford their own place. They move out. Now one household turns into 3. You have young people who are trying to move out of their childhood home. Maybe they're living with their parents. They want to get into that first apartment. Again, there's all kinds of different things. You have population growth, which is more of a macro standpoint, and that's more micro as it relates to what happens in housing in a specific area. oftentimes supply is going to drive demand, right? Demand comes down when prices increase, prices increase, rents increase. Obviously, there's less demand for housing because the housing affordability goes down, rental affordability goes down. Now, when you add a lot of supply, that demand increases, right? Because maybe you have a somebody living with a roommate. I'm going to use this example again. They couldn't previously afford a studio or one bed, but now all of the supply has been added. Pricing's coming down. Now demand increases because they're decoupling from a household standpoint. So you also just have a lot of demand that's driven by the increase in single family house prices and the fact that buying a home has never been less affordable than it is today. And that's primarily due to interest rates coupled with increasing housing costs from a rent versus buy standpoint. And that's also increasing rental demand. So long story short, there's all of this housing demand driven by a handful of different things. I feel like I haven't mentioned that affordability is a tailwind, and that's, again, driven by a lot of supply. It's also driven by the fact that wages have outpaced rent growth over the last couple of years, and therefore affordability is more in line with where it's been. I believe John Burns Consulting, which is a large real estate data aggregator, and long story short, they issue a lot of surveys, they collect a lot of data, they package into consumable reports and distribute to the subscribers or their customers. They do a lot of work with like custom home builders, apartment developers, etc. But John Burns shares this information on LinkedIn as well, which can be helpful. But long story short, rental affordability in terms of rent price versus income. A lot of us in the game know that when you're leasing an apartment, you want to see 3x income from a residence compared to the rent price. Right now, it's at 31%. 2024, it's at 31%, which is roughly where it's been over the last decade. And there was a little bit of a gap, or I should say a spike in terms of rents versus wages in 2021 into 22 that threw that metric out of whack. But now we're back into a much healthier balance, which again drives housing demand. So we're adding a lot of supply, but it's being absorbed. And again, I think this is the data point, and it's coming later into this whole spiel here as it relates to the third trend that I wanted to talk about. 9 months into 2024, we are on track for the second best year for net absorption in 25 years. And that's only behind 2021. So in the last 21 years, the last 25 years, the two highest years in terms of net absorption were 2021, 2024. And net absorption is essentially number of apartments being built and those apartments being leased. So there's still all of this demand, but we have supply falling off a cliff in the next couple of years because we haven't been in a very favorable market environment to start development projects over the last 2 or 3 years due to interest rates and due to construction costs and due to rents coming down due to the other supply being built. So all of this to say, in my opinion, unless there's some other legislative or economic shift that drives development again, we have significant demand for housing as we have had. That has not been a structural change, coupled with supply taking a bit of a nosedive in the next few years. In my opinion, that's really going to drive rents at a rate that exceeds what we would consider to be normal rent growth in a healthy market. 2.5%, 3.5%, something that tracks inflation depending on the market that you're in. We're set up for an environment in which rents are going to continue ripping again. What that number is, well, that entirely depends on the market, right? Again, Austin, Fort Myers, a lot of these markets that I talked about that had all of the supply being added. If they get back to zero or just small single-digit rent growth, great. That's a sign of a rebound in those markets from a rent growth standpoint. We're talking about supply-constrained markets. Those numbers might start to tick up into the 5, 7, 8+% range. And again, all of this is hyper-local, but I think that there's all kinds of these macro trends right now. I just shared 3 really significant data points that illustrate that indicate rents are going to continue to run, especially in C and B class apartments, of which new supply is not catering to. Now, again, supply lowers rents of at every single level from a class standpoint. A lot of people think that, they're not building Class C housing, therefore Class C rents are going to continue to increase. That's not the case. When you build a ton of Class A housing, it becomes cheaper, and therefore you have a lot of people moving up from Class B into Class A. You have a lot of people moving from Class C to Class B. It's a trickle-down effect. Supply lowers rents throughout the board, again, because there's a wider availability of housing. Now, that said, obviously that's different than building housing that's specific to a certain class, which has a much more immediate effect on that specific class of multifamily, their rents. So again, Class C, I think, is going to continue to run because it's going to not benefit from the trickle-down effect of new supply across the board. And we haven't built any, obviously, low to middle income housing outside of tax credit deals, project-based Section 8 LIHTC deals, et cetera. Well, I said LIHTC and tax credit, same thing. So I think this is a great time to be a buy and hold multifamily investor. I think that if you're buying existing assets over the next couple of years, you're going to benefit from the tailwind of falling supply and demand growth. I should say demand growth coupled with supply falling off a cliff. It's going to continue to push rents. And I think I'm telling a lot of the listeners something that they probably already implicitly believe or know. But there's a lot of data points very specifically that indicate that this is going to be a dynamic that is prevalent over the next couple of years. Now, again, if you found this episode helpful, hope you have the time to leave a rating and review for the podcast. Coming up on 300 reviews. We're in the high 200s. Would love to get to 300 by the end of the year. So if you're a listener who's learned anything on this podcast or taken anything away from what I talk about here on the feed, please consider leaving a rating and review. It takes 5 seconds, really helps the show. If you want to learn more about Sterling Realty Apartments, check out the link in the show notes. But again, thank you all for listening, and I'll catch you on the next episode.